Hello and welcome to another video on my YouTube channel. My name is Joris and today I have a video about what things you need to focus on when you want to start investing. So when you think that you are ready to start investing, you always need to ask yourself, did I educate myself properly? You can educate yourself by reading books or watching videos on YouTube. My channel, for example, you are already looking at videos from me, but in my opinion, one of the best channels to educate yourself on investing is the channel of the Swedish investor. So that's the channel of Erik Abrahamsson. And I put a link in the description down below, which is going to lead you to the first video of his playlist about the 7 best books for investors. And yeah, I really like his channel. He has a summary of a lot of books on his channel. He has very good videos on investing itself as well. So definitely go and check his channel out. Subscribe to his YouTube channel. It's free, just like subscribing to my YouTube channel is free as well. And then you get notification when he publishes new material. And it's also really easy that in the navigation bar you have the possibility to see all the subscriptions that you have. Then you can click his name and go to his YouTube channel immediately, so you don't have to type his name into the find or the search bar on top. You can easily click and go to his channel. Then you need to ask yourself, is there enough money in my emergency fund? If you don't have enough money in your emergency fund, first complete your emergency fund. Or at least be aware that you need to add money to your emergency fund while you are also investing. Then you also need to budget, because you need to know exactly how much money you can invest monthly or weekly into your brokerage account, so that you know for sure that you don't need the money that you are investing into the stock market. Because when the time is there that you do need the money that you have into your brokerage account, and on that time the market is down, you are going to sell with a loss, and that's not the thing that you want to do. You don't know when the market is going to go down. So for instance, now a lot of people are already saying for 2, 3, 5 years already that the market is way too overpriced. Now for sure with the AI bubble, it's all over the place. I even say it sometimes that I think a lot of stocks are overpriced. I'm not saying that the market is overpriced, because there are a lot of stocks that are still buyable, but there are a lot of AI stocks that are trading on a high PE valuation, and I don't really like that. Okay, PE isn't the only thing that you should look at, of course, but even with all the other metrics, I still believe that, for instance, Palantir, and I hate to mention Palantir all the time, but it's really overpriced. CrowdStrike as well, it's really overpriced. Yeah. It doesn't even have a PE ratio, because it doesn't have a profit just yet. So in that regard, PE isn't everything, but just make sure that the money that you invest towards the stock market isn't money that you need right away. At least 7 to 8 years you need to be able to spare the money, to be able to be sure that when you sell, that you sell with a profit. Then you also need to make sure that you have a plan. So an investment plan, really important. I will talk more about it on the next slide. And then you have to stick to that plan, because I always say it, consistency is key. So when you make an investment plan, you have to think about whether or not you are going to invest in ETFs or stocks. And I'm deliberately not talking about mutual funds, because in my opinion, mutual funds are always worse than ETFs. ETFs are tradable during the day, and mutual funds are often way more expensive than ETFs. So in that regard, I'm only mentioning ETFs or stocks. But if you want to invest in stocks, just be aware that your budget is allowing you to invest towards stocks, because you need to think about diversification. You know that I am investing into my U portfolio, and there I started from scratch. So in the beginning, I only had 3 stocks in my portfolio with the 500 Swiss francs that I put in at the beginning of September in 2024. And that's not ideal when you start like that. And I know that, and I also said it back in the day. But the thing is, we already have an ETF portfolio, and that is in fact then more of our core, and the U portfolio then has the satellites turning around the core of the ETF portfolio. And in that regard, I think ETFs are the best way to go for most of the investors. If you really want to go for stocks, go ahead, but keep in mind the diversification. And when are you going to invest? In this regard, I believe it's always the best to pay yourself first. So when you get your money of your wage being paid on your account, immediately transfer the money that you want to invest that month into your brokerage account and invest it. That's the best way to do it, because when you don't do it in the beginning of the time when you get your money, then you are going to spend money, and at the end of the month, when you don't adhere to your budget completely, you will have less or even no money left over to invest that month, and you are not going to be able to stick to your plan. And not sticking to your plan is not the way to go. So a good advice from me is, don't overcomplicate things. Start with 1 or 2 ETFs and pay in every month. So when you get paid, immediately transfer the money, and don't try timing the market. So from the moment the money hits your account, immediately invest it. Don't say, okay, but tomorrow it's going to drop, so I'm going to buy tomorrow. Or next week Trump is going to announce something and then the market will drop. No, don't think about it. Just do it. And it's even better if you can automate things so that you don't even need to do a thing. So put in an automation, an order to transfer the money to your brokerage account, and then in your brokerage account, when the money hits your account, it's immediately invested. If you are able to do that, do that. Then another important thing is always invest no matter what. So if the market is at an all-time high, you don't care, you still invest the money that hits your account. If the market is dropping like a rock, you don't care, you keep investing on the same time as always. You just don't care, and you do what you are supposed to do according to your plan. Is that boring? Yes, it is. But who cares? You are growing your wealth and you are taking care of yourself. The only thing that matters is sticking to your plan. The advantages of ETFs, I already said something about it, but here is the overall advantages. So they keep your costs low compared to mutual funds and stocks. Most of the time, investing in ETFs is way more cheaper. You also have a total expense ratio of your ETFs compared to mutual funds. That one is low as well. And then also be aware that your brokerage account should be low cost as well. You know, I'm trading on U platform for my stocks investments. There, the investment fee for investing in stocks is really low. Our ETF portfolio is on Swissquote. That's more, yeah, it's more expensive to invest there, but I don't like the free brokerage accounts where they are in fact also lending out your ETFs to other parties and they are then shorting with your ETF shares. So that's something that I really don't like. So always look at what the brokerage firms is doing with your shares and how they are making their profit. If you don't like it, go for another brokerage firm that's maybe a bit more expensive, like my wife and we are with Swissquote. So way cheaper than trading here at banks in Switzerland, but there are cheaper brokerages around in Switzerland, but we are deliberately not dealing with them because they are doing stuff with the ETFs that we actually don't want them to do. And if you then select, for example, with the Giro from, okay, we don't want you to do what you are normally doing, then in fact, trading on that platform becomes as expensive or even more expensive than on Swissquote. So always check what you are doing and what they are doing. Another advantage of ETFs is that they are inherently diversified, because if you buy one ETF, you are investing into a diversified index. So, and that index has then X companies. Check that out. You can always check what the index actually entails, so know in what you are investing when you are buying an ETF. And another thing is, if you are buying an ETF, you are following that index. And when you are following an index, you are beating at least 90% of investors who are trying to beat that index by buying the stocks individually. That's just the thing that is already showed multiple times, and that's why John Bogle started with the mutual funds following an index. And yeah, it's just the best thing to do. Okay, there is also critique on it that all that passive investments are actually screwing around with the valuations of the underlying stocks. But I don't believe that that's actually the case. There are still a lot of active traders around, and when the market would be so inefficient, those guys would make a lot of money. And when they are making a lot of money, there will come more and more active traders compared to passive traders. And in that regard, I'm not worried at all. And then, of course, one of the most important questions where there is a lot of debate about, and in my regard, there is no question about it, what you should do. Okay, dividends or not, when you invest in stocks, you don't need to care whether or not a company is paying out a dividend, yes or no, because in the end, the overall return is what matters. As long as your company is doing great, the overall return is going to be great, and that's all that matters. So always remember that. I'm a dividend investor, but if I see an opportunity in a stock that I really like that doesn't pay out a dividend, I will buy it. No hair on my head will turn the opportunity down. And for the other part, I like dividends because they keep me motivated, especially when investing in ETFs, because I already said it, investing in ETFs, it's a bit boring, and I know it. And seeing then the dividends come in, it makes investing a little bit more exciting. And it's also a thing that gives me more security. It's a false sense of security, I know that. It's just a thing. It's just psychological, and I like dividends for that. Just be aware that high-yielding stocks or ETFs with a dividend yield that is higher than 6 or 7%, are often not the way to go because they can be a yield trap. It's not financial advice, it's just observations that I make. A lot of stocks that give 7 or 10% right now on the stock market because they are undervalued, they can be a good buy, but do your homework, do your research, and just keep an eye on the results that they are presenting, so that you don't get taken by a surprise that they cut their dividend, and when they cut their dividend, the price of the stock will fall immediately. But there are a lot of stocks that have a dividend yield of 3-4%, and in my opinion, they often don't have a problem for being a yield trap. Like I said, it's not financial advice, it's just the way that I'm used to invest. And a lot of people now, when they talk about high yielding stocks, they talk about yields of 3-4%. And in my opinion, 3-4% isn't high at all. Especially here in Europe, 3-4% is no exception. So, okay, you can buy technology stocks which only pay out 0.20, 0.30%, and they grow their dividends very rapidly. But just keep in mind, those are exceptions, and they are really good investments as well. But it's just what you like, that's up to you. And another thing that I want to put straight is that a lot of people are criticizing covered call ETFs, and they are saying, hey, they give a high dividend yield, so they are dangerous because they can be a yield trap. That is not a yield trap at all, because it's not a high dividend paying ETF, it is a high income paying ETF, because the income comes from the premiums that they get from their covered calls. So it's not completely the same thing. You have, for example, SDIF, that's a high yielding dividend ETF, an all world high yielding dividend ETF, and that's because they are investing into stocks that pay out a high dividend. SDIF is way more dangerous than the covered call ETF JEPG. Okay, you still have the same downside, JEPG as DIF, but on the other hand, you're way more sure of your high income from GPAC than from the covered call and then from SDIF. There are a lot of different opinions about that. Also, the last year and a half, SDIF is performing quite good actually, but in the first few months of its existence, it lost 30-32% quite fast, and that was because they invested in the wrong stocks. And yeah, it can happen, but just be aware of it. And if you are young, go for an all world ETF. If you want dividends, go for a low dividend yielding all world ETF. VWRL is a good one. And if you are older, go for all world ETF as well. And maybe go, because you are older, for a higher dividend yielding one. And then you can go, for example, for VHYL. That's just an example. I have a lot of videos about all world ETFs. It was one of my last series that I made. So there were 5 videos in that series about all world ETFs, and you can go and check those out and make up your opinion on those, and yeah, choose the one that fits you the best. But always do your own research. It's really important. And then it all comes down to the plan, and stick to it. So if you want to go for dividends, go all in on dividends and stick to it. Don't be discouraged by people that are going for accumulating ones, and when the market is going up like a rocket, they will say, I am 20% in the green and you are only up 13%. And don't be discouraged by that, because you still have 4% dividend coming in as well. So you're actually not that far off from the 20%. You have then 13 plus 4%, so 17%. And they will say, yeah, you are paying taxes and I'm not. But a lot of countries also have taxes on capital gains. And because they have accumulating ETFs, they have way more capital gains than you. And in the long run, sometimes the tax on capital gains can be way higher than the taxes you need to pay on your dividends. So yeah, it's a weighing game, and you have to make your own decisions. And when you make your decisions, just stick to it. And then what you don't need to focus on. That's also really important, because a lot of people, they focus on all kind of things, but sometimes they also focus on the wrong things. So what you don't need to focus on is on what the market is doing. You don't care about the market. Also, you don't care about how others are doing. So also not how I am doing. Okay, you can still follow me here on my YouTube channel, of course, but it's just a thing. You are not me. And if you are following the market and you are thinking, man, now the market is really overheating, and you start investing irregularly, that's not the way to go. Just stay consistent. Consistent cost averaging, you know that I hate the term dollar cost averaging. I like consistent cost averaging, so that's a term that I want to introduce to everybody, the CCA instead of DCA. Consistent cost averaging is just so important. And on the other hand, you are not me and you are not them. So for example, what I hear often is that people, they say, yeah, I only can invest 100 Swiss francs per month, and that's just a silly amount to invest. It's not true. It's for you, it's a significant amount, and even though it can feel like it's a silly amount. So I put the example here that you are already investing for 5 years. So 100 Swiss francs per month for 5 years means that you have 6,000 Swiss francs invested. With some returns, you have maybe 7,500 Swiss francs on that moment on your account. And then a friend of you that earns a lot of money says, yeah, I'm now putting in 2,000 Swiss francs per month. And after 4 months, you are up to 7,900 Swiss francs, and he is up to 8,000 Swiss francs in his account. Then you can feel like, man, I'm struggling for 5 years and a half, more or less already, and he's catching up in 4 months. So what am I actually doing? Don't break your head on it. The only thing that is important is that you are putting in everything that you can, and that is that 100 Swiss francs every month, and you are increasing your wealth. You're doing your best, and he can actually maybe do more, because when he really put effort into it, he could put 3,000 Swiss francs per month into the stock market. It doesn't matter. Don't be jealous. That's just the way the world works. Some people earn a lot of money, some people earn less money. It's all what you do yourself. So keep the focus on you and your progress. That is the only thing that matters. So it is your portfolio and the number of shares that is growing that is the most important thing. All the rest is, yeah, just white noise. Don't worry about it. You need to take care of yourself. And if you invest in dividend ETFs, you can also focus on the annual dividend that you are receiving from your portfolio. And that is what, yeah, what I like on investing into dividend ETFs. You see it in my journey on my YouTube channel. So our dividend ETFs, our portfolio is growing the annual dividend every month. We only had 3 or 4 drops so far during our journey that started in 2016. And yeah, it's a long way. There are a lot of people with a lot more money than me, or than us, than my wife and I. But in the long run, the only thing that matters is when I retire and when my wife retires, that we can live a comfortable life. We are living a comfortable life right now, so we are not saving like crazy, like some people that aspire the fire or aspire fire, so the fire movement, financial independence, retire early. They save 70-80% of their wage after taxes. When we do that, we can't go to football games, we can't go uh, to Boulder sometimes, we can't go on a trip sometimes, so that's just stupid. You have to live your life, you have to live a comfortable life, you need to try to save, and even 100 Swiss francs is important in that regard. And with that being said, I thank you for watching to this video. Please consider subscribing to my YouTube channel. Also check out the channel of the Swedish investor. Really great channel. Hit that like button as well, that helps out my channel enormously. And thank you for watching, and see you on the next one on my YouTube channel. Bye.